Hello everyone, Sarah Stokes here with your weekly mortgage and interest rate update for Saturday, February 22nd, 2025. Whether you're a realtor, financial planner, or business referral partner, or a potential home buyer, staying ahead of the market trends is crucial, and that's exactly what we're here to do. This week has been full of important updates that could impact real estate and lending, so let's dive right in. On this past Tuesday, President Trump spoke. While he didn't directly address mortgage rates, some of his proposed policies could shake things up. For example, a proposed 25% tariff on lumber could make new construction even more expensive while driving home prices up. Potential workforce cuts in the FHA and HUD and Ginnie Mae may slow down affordable housing projects that were underway. Concerning economic policy, Trump is pushing to replace income taxes with higher tariffs, hoping this will boost the economy and lower interest rates. It's a bold move. Stay tuned, it could go either way. On Wednesday, housing starts reports came out. Housing starts were down 9.8% from December, lower than expected at 1.366 million. Since real estate is often the first industry to feel a recession, this is a key indicator to track. On Wednesday, there was also a Federal Reserve update. Raphael Bostic, president of the Atlanta Fed and a voting member of the FOMC, released an essay predicting 2 rate cuts in 2025. He was also interviewed and says he sees the neutral interest rate at 3 to 3.5%. But right now, we're actually sitting at 4.25% to 4.5%. So there's definitely room for cuts. He says he anticipates the Fed will make 2 cuts in 2025. So what are the biggest risks that the Fed sees? Inflation and the Trump administration policy uncertainty. For example, tariffs could affect inflation. Another example is workforce changes, especially mass deportations that might shrink the labor and industries like construction, affecting supply and demand. The Fed is on pause for now, waiting for more clarity before making cuts to the federal rate. However, lower rates later this year seem very likely. On Thursday, initial jobless claims were released and were higher than expected, signaling potential weakening labor markets. The Philly Fed Manufacturing Index was also released and was lower, possibly pointing to a slowdown in production. So how did mortgage rates react? Well, favorably. These reports helped push rates down as the market reacted to signs of economic softening. Inflation does still remain a concern, though, so we will be watching closely for more. Finally, on Thursday, crude oil inventories came in higher than expected, which could be a potential driving force increasing inflation. On Friday, the manufacturing PMI was stronger than expected, which is generally supportive or bullish of the US dollar. The services PMI was released and weaker than expected, a negative or bullish economic indication. Existing home sales came in lower than forecast, another bearish signal for the dollar. So what does all of this mean for mortgage rates? Well, mortgage rates are currently hovering lower than they were last week or the week before. It's 6.87 to 6.89%. It's a 6 handle, guys. That's amazing. Home sales dropped to 4.9% in January, while home prices rose 4.8% to 396,600. So first-time home buyers only have a 28% share of this purchase, which is a historically low percentage. Investors have an even lower percentage, although in my business, I'm seeing more and more investors come out, especially in the North Carolina area. So what do we need to focus on? Well, we need to focus on inflation, and we need to talk about mortgage interest rates. The Fed's target inflation rate is 2%, balancing economic growth while preventing price instability. That's what they're hoping for, is the 2%. So they're going to be monitoring that and watching it. Right now, we're at 3.3 to 3.6%. So key reports coming up next, the first couple of weeks in March are the CPI, that's Consumer Price Index, and the PPI, the Producer Price Index. And that will help us. Those are clear indicators of where inflation is. So this past week in equities, the Dow, S&P 500, NASDAQ, and Russell 2000 all dropped, while the VIX, that's the volatility index, spiked. While investors get nervous, they shift money. Okay, so this is what happened. They're shifting money into safer assets like U.S. Treasuries, which can then push mortgage interest rates lower. So this is a good thing. If this trend continues, we could see a slight dip in rates in the short term, but mortgage rates can be unpredictable and timing is everything. So keep an eye on it and like and follow me for more information like this. DM me if you have any questions, and don't forget about subscribing to my newsletter for weekly updates. See you next week.